Hello, everyone. Thank you for joining us today. It is 1 o'clock Eastern, and we are ready to start our presentation talking about employer payroll relief that's included in the two major tax bills that were passed in March as we're going forward today. So thank you for joining us. Wanted to introduce our presenters. Ann Yancey, she's a director and spends her time with our state and local tax team. She deals with credits and incentives, and as part of that spends a lot of her time dealing with payroll issues because new jobs and how you pay and compensate people is an important part of dealing with any state credits and incentives efforts. And then Deb Walker, you are probably familiar with Deb. She's been on a lot of our calls here with the CARES Act and the Families First Coronavirus Response Act. Deb is our National Director for compensation and benefits and all things tax related to compensating employees and workers. So with that, just a quick reminder that we are covering these areas. There's still guidance to come, and your particular facts and circumstances need to be taken into account as you deal with the information that we're presenting today. So today's presentation, we're going to be, again, covering the Families First Coronavirus Response Act and the Coronavirus Aid, Relief, and Economic Security, or CARES Act. And in particular, we're going to be talking about the employee retention credit, how that works, the employment tax deferral opportunity, both of those from the CARES Act, and then how those work together with the mandatory paid sick leave and paid FMLA leave from the FFCRA. And then we've got a couple of examples to work through to demonstrate how this can apply, and some planning tips and thoughts on how to work with all of these areas when employers are looking at the group. So first, let me just cover a big picture. And the big picture starts with the first piece of legislation we received, the FFCRA. And this is a mandatory provision, and it really mandates that businesses with fewer than 500 employees must provide paid sick leave and paid FMLA leave for their employees who request it. But on the flip side, the provision in this act said, hey, if you provide this, even though the federal government is mandating that you provide these benefits to your employees, but as a response back and a relief to you, the employers, you can get fully reimbursed for this, plus a reimbursement for your healthcare costs that you're going to continue to maintain for these employees that are claiming one of these two leave provisions. So that was the first piece, and it's strictly for employers with fewer than 500 employees, looked at on an integrated employer basis. The second piece came out in the CARES Act, and it was much broader. It really covers all employers. All employers were allowed to take into account the federal employee retention credit and the federal employment tax deferral. I keep saying federal because I want you to know today we're just talking about federal payroll taxes. We're not talking about state. States may have their own incentives and programs, and Ann is keeping up with that and can talk about where some information is on our website with regard to that. But really, we're just talking about federal taxes. So the CARES Act came out and said there's two opportunities here. One is if you're putting people back on payroll or keeping people on payroll and they're not really working, or you're struggling to keep them busy or doing work, but you want to pay them anyway, we'll help you by giving you some credit for that to offset those costs. And the second was, the IRS or the Congress said, we'll also give you an opportunity to defer paying some employer payroll tax until later. And we'll be talking more about the details here. So the third piece of the pie was the Paycheck Protection Loans. These were for employees with 500 or fewer employees could apply for these loans and their impact. This was also in the CARES Act. But for employers who are taking advantage of that, that really moves them out of the other two opportunities under the CARES Act. Now, we'll see on the next slide, it moves them out of one provision immediately and another one on a delayed basis. But basically, if for an employer that takes advantage of the Paycheck Protection Loan Program, they're not going to be able to fully benefit from these two other provisions in the CARES Act. A couple other big picture things I wanted to share with you. The IRS said, look, with all of this going on, it's going to be complicated to figure out your quarterly, not only your deposits that are due after a pay period, but also your 941 and quarterly reporting. We are waiving penalties for under depositing payroll tax for the second quarter. Now, everything will have to be trued up by the time the 941 is filed at the end of July. But under this Notice 2020, there's an opportunity to waive any penalty. So it's okay if you get it wrong, or underestimate or overestimate. We could figure this out, but there's not going to be any penalties due right now for that. As I mentioned, there will be a reconciliation, and we've not seen that yet on the Form 941. The IRS is working on that, but we'll have a better understanding of their sense of ordering and application when that reconciliation comes out. So back to the payroll protection, just as a quick reminder, because we're going to spend a lot of time talking about the programs that don't apply to folks taking the payroll protection loans. The employee retention credit is not available to anybody that takes a Paycheck Protection Program loan, period. Cannot take advantage of that. The employment tax deferral program, you can use that up until the loan is actually forgiven. So employers can participate in the employment tax deferral up until such time as the loan is actually forgiven by their bank. So with that big picture in mind, Anne, can you share with us now some more details about how the employee retention credit works?
Okay, thanks, Sarah. Good afternoon. Okay, so let's dig into the employee retention credit. It is for qualified employers. It is a refundable payroll tax credit that's equal to 50% of qualified wages that are paid after March 12th of 2020 and before the end of the year. So let's break down a few of these definitions as we go through this analysis. The maximum credit for each person is $5,000, and that's going to be based on $10,000 of qualified wages. And what are qualified wages? It's going to be your regular compensation or salaries plus qualified healthcare costs. And we'll talk about this in a little bit more detail. And as Sarah has mentioned, the retention tax credit is not available to anyone that's going to be receiving a payroll protection loan, and it is also not available to government employers. Okay, so who is it available for? The program is available for any trade or business or nonprofits in 2020 that have partially or completely suspended any of their operations due to government orders. Or, and that is an or test, or a company that has had its gross receipts during any quarter in 2020 that are less than 50% of the gross receipts in the same quarter last year. Okay, so the second test is a little bit harder test to meet. But I think a lot of companies will actually qualify under that first test of just having partial or total suspension of their operations. And under the second test, the gross receipts test, if your company has to qualify under this test, the retention tax credit is only available, again, for the quarter that you drop gross receipts less than 50% up until your receipts then go back up to 80% of those same gross receipts for the prior year, the same quarter of the prior year. So once your operations rebound. Next slide. Qualified wages. So we've talked about what employers are eligible for the credit. The next step in determining what your qualified wages are for purposes of calculating the credit is to determine whether you have more than 100 employees or less than 100 employees. And this is looking at more than just your full-time employee count. Part-time employees may also count, based on the number of hours they work over a month's period of time. And you actually have to aggregate the hours of your part-time employees and calculate that average over the year to determine how many of your part-time employees will count as full-time equivalents for this 100-person test. Once you've determined whether you are now eligible as an employer with less than 100 employees or more than 100 employees, then you look to those wages for the particular employees. If you have less than 100 full-time equivalent employees, then all the wages for all of your employees will count toward this credit. So again, you're going to look at wages during the period you have the suspension of operations or during the applicable quarters where you've had a reduction in your gross receipts. Next slide. If you are an employer with more than 100 full-time equivalent employees, the only wages that are eligible for the credit are those that are going to be paid to employees that are not performing services. We get a lot of questions on what does it mean to be not performing services under this definition. And again, this could be where your warehouse or your manufacturing operations have been closed temporarily, and you're still paying your employees, but they are not eligible to come into the work location. That can be counted as part of this type of a situation. Another example I've heard from a client is a situation where they determined that they had an employee that tested positive for COVID-19, and they had to completely close their operations to have cleaning services come in and clean their offices or those locations. And that day, those offices were completely shut down. So those are just a couple of examples of where wages are being paid to the employees, but those employees are not actually performing services. And also in looking at that in 100 employee count, you must consider all of the entities within your related party or controlled group. So an employer will include all of these type entities, and they will all be treated as one employer for this 100-person test. So any brother-sister corporations or any affiliated entities will be counted as one. Okay. Also, when you're looking at the wages that will be counted as part of this credit, it must be done on a per person basis. So if your company utilizes a PEO or professional employer organization, which normally reports those wages under their own federal ID number, those are still your wages and they will count for your credit, for the retention tax credit. It excludes wages that are paid by related family members or individuals in the company that are considered related to the business owners. It excludes wages that are already being counted for other type of wage tax credits. And an example of this is if your company is already taking a work opportunity tax credit and that individual is already being given a credit for their eligibility under the OASDI program, you cannot double count them for purposes of the retention tax credit. One item here I want to mention on this bullet, because many companies will be taking work opportunity tax credits and possibly other credits. There's been no specific guidance on this yet, but if you have an employee that has already tested and been certified and eligible for a WOTC credit, and let's say they also will be eligible for retention credit, if there are enough wages for that individual, I think that the IRS will issue further guidance on this, that you will be able to take both credits. What they have said at this point in the guidance is that an employer cannot take credit for the same wages for multiple credits. So again, as long as the individual has enough wages to cover both credits, I think you will be able to take both credits. So just a consideration there. And again, you cannot also double count wages that are already going to be taken for sick leave and family medical leave that Deb is going to talk about later. And again, for the retention tax credit, the maximum wages for each employee that can be counted is $10,000. Okay. The credit is, again, we've mentioned it's a refundable payroll tax credit, and it offsets the employer OASDI, which is your 6.2% or commonly referred to as your Social Security tax. And in 2020, the wages for that tax are your $137,700 for each employee, or up to that amount. So the 6.2% Social Security tax is the only thing that the retention tax credit can offset. If there is any additional credit available, you can also offset remaining federal payroll tax deposits amount that are being paid against your federal income tax or your employee portions of Social Security and Medicare. And lastly, the IRS has released Form 7200, where you can ask for immediate relief and get money back as a refund for any of these credits that are over your taxes. It can be faxed into the IRS and processed so that you can get your cash back immediately. Again, we just mentioned that it offsets only the employer portion of OASDI payments. This is really also an ordering rule that has to be taken into account with this tax credit. It is considered after the paid sick leave and family leave credits that Deb is going to talk about. If your company is taking startup R&D tax credits, and or you're a nonprofit that is also claiming credits for veterans, the retention tax credit is utilized after those credits or applied after those credits in that order. The retention tax credit, again, can reduce any payroll tax deposits against other taxes to the extent that you've already wiped out all your employer Social Security tax as well. Again, as Sarah mentioned, these credits are all taken on the 941 that's filed quarterly. It's easy. It's going to be easier to reconcile this on a quarterly basis at the end of the quarter when you file the 941 to determine exactly how you flow these through, even though you can offset deposits on a pay period basis.
All right. Thank you, Ann, very much for walking us through the employee retention credit. And Deb, I think we're up to the other piece of the CARES Act, and that is the deferral of the federal employment tax.
And this is a great opportunity. It applies to all employers, even those employers that have taken advantage of the Paycheck Protection loans. So let me explain what it is. It is a deferral of the employer share of OASDI tax. That's 6.2% on the first $137,700. It is not a deferral of the Medicare tax that the employer pays, and it's not a deferral of any taxes that the employee pays. It's a deferral of the employer share of OASDI tax, those amounts that are paid between March 27th, 2020, the date of enactment, and the end of this year, December 31st, 2020. It is a deferral. You will eventually have to pay those taxes. Those taxes will be paid 50% on December 31st, 2021, and 50% December 31st, 2022. Of course, if you're using an outside payroll provider, you need to tell that payroll provider to defer those amounts or not to pay those amounts in order for the deferrals to occur. And for the individuals that have a payroll protection loan, the deferral only applies to the amount before the payroll protection loan is forgiven. So, you know, people apply for a payroll protection loan. A number of people are already getting those loans and their 8-week period is starting. They then have an 8-week period to spend that loan on certain expenses. And then they come in and ask for forgiveness of the loan. The banks will then review the forgiveness documentation. And when the document forgiveness is approved, that's when the deferral of the employer share of OASDI wages has to happen. It has to stop. Any amounts that you've deferred between March 21st, 2020, and the date your loan is forgiven, the approval from the bank, can continue to be deferred until 2021 and 2022. So interest-free loan for everybody. Some people say not enough money for me to worry about.
And Deb, isn't it, you'll have to work out if you tell your third-party payer not to pay, then you, the employer, become responsible for making those deposits later. They're not going to go back to that third-party payer. They expect it to come from you, the employer.
Yes, you are going to, it's clear from the statute that you're going to be liable. Exactly how it will be paid, whether it'll be an extra line item on the 2021 941 for the fourth quarter or the third quarter, or they haven't told us that yet, but it is important that you are liable. Where you use a PEO, you're accepting liability for that tax again if you're using a PEO.
All right. Well, that covers the two major provisions for all employers in the CARES Act. But Deb, let's go back and take a quick walk through the FFCRA and the mandated paid sick leave and paid FMLA. Just help us understand and get a refresher on these rules.
Yeah, and this is important because these rules apply to anybody that has fewer than 500 employees determined on an integrated employer basis. And we continually run into people who don't think these rules apply because they're too small. Family medical leave sometimes doesn't apply. And that's not the case for this mandated paid leave provision. So what does the mandated paid leave provision provide? It provides paid sick leave to workers who are either quarantined, self-quarantined under doctor's orders, or experience symptoms and seeking medical care. In addition, they call it paid sick leave, but you're able to have paid sick leave for taking care of children who are home from school and have no other child care, or people who are sick with COVID-19. In addition, the paid family medical leave applies for parents to take care of a son or daughter whose child or daycare is closed. So you can see there's a little bit of an overlap between paid sick leave and paid family leave, and you'll see as we go through the provisions why that overlap occurs. Finally, even though you are required to make these payments, you will be repaid the amounts through a refundable tax credit, offsetting your employment taxes in the time period. And you'll see, just as Ann talked about, you offset the deposits in the same period for which you made the payment. So the refund is almost immediate. So who does this emergency paid sick leave apply to? As I mentioned, it applies to governments, not-for-profits, private employers with not-for-profits and private employers with fewer than 500 employees. There are some exceptions. One is that healthcare providers and emergency responders can be denied these paid sick leave if their employer chooses to do so. And an exception that a lot of people think applies, but actually is very limited, is the small businesses exemption. Small businesses with fewer than 50 employees are exempt, but they have to be exempt only because the imposition of the rules would jeopardize the business as a going concern. And the Department of Labor has issued guidance into how this provision would operate. And under this guidance, an officer of the small concern has to represent that one of three things. The payment of sick leave results in financial obligations would exceed revenue, which would cause the operation to cease operating at a minimal capacity. That the absence of these workers requesting the leave would be substantial risk to the organization because of their skills, knowledge, or responsibility. Or that if these workers were paid sick leave, there wouldn't be enough other workers to perform the work of the people requesting leave, and then they couldn't operate at minimal capacity. So you can see it's a self-certification, but the standards are fairly high. So what do all these people have to pay? This slide is color-coded because you have to pay two separate amounts. If you're paying for somebody who can't work or telework due to being sick, being quarantined, being self-quarantined by a healthcare provider, or experiencing symptoms, you have to pay 100% of their wages up to $511 a day. Then if you're paying this sick pay leave for taking care of somebody or taking care of a child, you have to pay two-thirds of their wages up to $200 a day. The sixth bullet on here doesn't really apply because we don't have any substantially similar conditions that HHS has provided. Okay, so how much do you have to pay? I mentioned it for emergency paid sick leave. That's only a 10-day payment, 80 hours. It's the greater of somebody's regular pay, or $511 a day. And that's for people that are sick. For people that are taking care of others, it's two-thirds of pay, limited to $200 a day. And one of the provisions in here is, this is emergency paid sick leave. You cannot require the employee to use any other first. I had another question recently, well, we already give them 40 hours of paid sick leave. Do I have to give them 40 or 80? No, this is 80 additional hours to whatever you already give these people. So how much do we pay for mandated, and this is another thing, for the mandated paid family medical leave. So mandated paid family medical leave is only for a parent taking care of a son or daughter because their school is closed. It's only paid for the 3rd and the 12th week of when somebody is out on family medical leave. So that's why there's 2 weeks of pay under paid sick leave, and then 3rd week would be paid under mandated paid family medical leave. One of the other provisions that's different for family medical leave than it is for mandated sick leave is the employees have to have been employed for 30 days. And while they're getting their 2 weeks in their paid sick leave, it doesn't count as part of the 30 days. They have to be employed receiving regular wages for 30 days in order to be have mandated paid family medical leave required to be paid. And then just the last bullet on that page, for your 2-week period when you can't get the amounts, you could take regular PTO, vacation, or other sick leave, or use the paid sick leave, as we mentioned. Okay, so how do employers get relief and so that they don't really bear any of these costs? Well, the first thing that applies to all employers, governments and non-governments, is that this emergency paid sick leave and emergency paid family medical leave is not wages for the employer portion of OASDI, the 6.2% times 137,700 per year. For non-government employers, the wages paid become a tax credit, just like the employee retention credit. It is a tax credit against all your payroll taxes that are paid by all employees. And you'll see as we get to the end, we do some examples showing how these wages can offset taxes paid to all employees. So things to remember, how much tax can be generated. I haven't mentioned this yet. So it's emergency paid sick leave wages that you've paid, family medical leave wages that you've paid, and qualified healthcare expense allocable to employees during that period. So when somebody's receiving paid sick leave and paid family medical leave, then you can also claim a credit against your payroll tax deposits, eventually reconciled on the Form 941, for the healthcare expenses allocable to those people. And finally, remember, I made a big deal about you don't have to pay the employer's share of OASDI. You do have to pay the employer's share of Medicare taxes. but you get a credit for having paid the employer share of Medicare taxes on these wages. I'm not sure why Congress separated this out and made you pay it and have a credit. I think it has to do with the Social Security Trust Fund and the Medicare Trust Fund. Okay, how do you claim the credits? The same way that Ann talked about with the employee retention credit. You reduce your payroll tax deposits by your anticipated credits. To the extent your payroll tax deposits for all the wages you're paying to all the employees is not sufficient, then you can apply for a refund using Form 7200. The statute makes it clear that you don't get an income tax deduction for these paid leave amounts on your income tax return. Employers can elect out of taking the credit. I'm not sure why anybody would do that. And unfortunately, the credit is not available to government employers. Let me turn it back over to you, Sarah.
Great. Well, I'll tell you what, that's a lot to go through. And for me to understand it, I needed to get Deb to create a couple of examples for me. So if you'll let me walk through these examples, we'll see how it applies. So first, we have an employer with about 125 employees and a weekly payroll of $250,000. You could see that in normal times on that weekly payroll, their federal tax deposit would be about $68,250, made up, as you see below, the employee share of OASDI and Medicare totaling $19,125, employer portion $15,300, and Medicare at $3,825. And this employer pays $150 a week per worker for healthcare expenses. So first we have employee A. Now employee A is going to fall under the mandatory paid sick leave. And that person normally earns $350 a week and they're self-quarantined. So they've asked their employer for this emergency paid sick leave, requested it. The employer runs through the calculation to see if they're going to run up against that $511 a day cap. They do not. So the employee is going to get their full benefit for the 10-day period under this plan for those hours. Then we have two other employees, B and C. Now B is just working as usual, but working from home, and C can't work at all because of the impact of the business. It's got a partial suspension. B can still work, but employee C cannot work at all. But the employer decides to keep paying B and C anyway during this time period. So how does that look? So here's the weekly payroll. We're paying A, who's home sick under the paid sick leave. We're paying B, who's home working, and we're paying C, who's home not doing anything, but paying them as well. You can see that the employer share of OASDI is not required on employee A under the paid medical leave, paid sick leave, but their share of Medicare is due. But when we look over to the right, how do we get a credit? Well, A, certainly we get the credit under the FFCRA. We get their health care and we get their Medicare. All of that goes into their credit. B is working. We're over 100 employees, so we cannot consider B's wages, even though the business is facing some sort of suspension, partial suspension. We would not be able to count B's wages. We would if this employer had under 100 employees. And then C is going to fall in that employee retention credit. And remember, that's a 50% of wages, qualifying wages. And so 50% of C's weekly wage of $500 and 50% of the health premium. And we would track this because now we're up to $650. We would track that until C reaches $10,000 and not include any additional credit there. So we've got a total credit generated here of $830. So what does that look like when we get to our deposit for this pay period? Originally, our deposit would have been $68,250, but first we get to exclude the wages under FFCRA that are not subject to OASDI, so that's the $22 subtracted out. Next, I'm going to defer the balance of my OASDI payment right now and pay it over at the end of 2021 and 2022. Then I'm going to come down and calculate what remains of the deposit I need to make, and then I'm going to apply my credits against that deposit in full. So netting down to a payment of only $52,120. So realistically, the government has provided me an opportunity to reimburse me in full for what I had to pay for the person out on paid sick leave, and in good portion for the people that were out that are not working right now that I helped to pay for. And I've been able to defer with a short-term interest-free loan for the deferral. Example 2, now we've got 200 employers, a bigger payroll, 177,000, weekly payroll deposit of 62,658. You could see the same pieces here in the employer share of OASDI, employer Medicare, and again, we're paying $150 a week for each worker. In this case, we're much more impacted by the coronavirus and its impact on our community. So we've got 10 employees who usually earn $500 a week. They're all self-quarantined under doctor's orders. We've got 30 employees who generally earn $500 a week, but they can't work. They're home taking care of a child whose school is closed or daycare is closed. So we run the tests to compare against the maximum allowed per worker per day, and both of these fit within those frameworks. So the 10 employees, we're going to pay paid sick leave for $5,000. The 30 employees we're paying sick leave or paid FMLA, and they're getting $10,000 in total wages. The employer, again, does not have to pay OASDI on these wages, on these $15,000 of wages, but is required to pay the $200 of Medicare tax. All right, in addition, as to the other bulk of the workforce, we got 60 employees that normally earns $750 a week, but they're not working at all because of suspension in the business. We're still paying them, but they're not able to work. And then we've got 75 employees who normally earn $1,000 a week, but you know what? We've got them on a reduced schedule. They're only working 20 hours per week due to partial suspension of the business. Even though we're still paying them for a 40-hour work week, they're only able to work 20. And so they're under a partial suspension there. So how does this deposit and the credit calculation look? So the first employees, the 10 employees and the 30 employees, they fall under the FFCRA. So no OASDI due, and the credits for their full wages paid, their full health care, and their Medicare premiums. The next group, the 60 employees, they are not able to work. We get a credit for 50% of their wages. That's the $22,500 plus the portion of their and half of their healthcare costs. Then we have the 75 employees who are working half-time. So we have to go in and figure out we're over 100 employees, so we only get credit for the ones that are not for the period that they are not working. So again, they're not working 20 hours a week, so that is all that I'm eligible to get a credit for. So I've got to go in and figure out how many hours they are not working so that I could get that figure that benefit. And it actually works out to be the credit for their wages, $18,750, and their healthcare premiums, $2,813. So I've got a total credit now of $69,781. So when I look at what my deposit is going to look like, again, I'm going to, my normal usual deposit should have been $62,658. I get to exclude the OASDI tax for those that are taking the mandated paid sick leave and FMLA leave. Then I'm going to defer the remainder of my OASDI payment and then figure out what is due, take my credit against it. And as a matter of fact, I now have an excess credit. So I'm going to immediately fax the form 7200 off to the IRS to get a refund of that $18,128. So I'll have it in my pocket to make next payroll as soon as I can get the money into my account. All right, so with those, let's move on to some planning and think about what we can do planning wise for here. So Ann, you want to talk about managing cash during this time?
Okay, so in looking at Sarah's examples, you can see that calculating the credits at every payroll tax deposit may be very difficult. I mean, you're really going to have to calculate the credits on an employee by employee basis and track them every payroll tax deposit. But this is the most effective manner to manage your cash and keep it on hand, is to look at it on a payroll period by payroll period. The IRS is providing some relief, however, if the company chooses to do the calculation on a pay period basis or a quarterly basis, and maybe possibly do some estimates. Oftentimes, some of the credit data, it may be difficult to get until the end of the quarter. So it may be easier to do credits at the end of a quarter. And in that case, you can immediately defer your employer portion of your Social Security or OASDI tax. That's a given. That's an automatic. That's what you should be asking your payroll provider to defer right now. Again, if you do your credits on a pay period basis, or whether you do those at the end of a quarter, then those can also be taken into account to reduce your other taxes. The IRS is providing relief against any penalties for failure to deposit correctly during the second quarter of this year under Notice 2020-22. So that should help as well. And you can just do a true up or catch up at the end of the quarter and make any adjustments as necessary. I will say that we've been in touch with a few payroll providers, and I've heard that some of those companies are unable at this time to allow companies to take both a tax deferral and certain of the tax credits, the retention tax credit, for instance. And it's not that they are challenging the law. Their systems are not capable at this time to handle both of those adjustments. So, and again, what I've been told is that they are working on their systems to accommodate this. It's just as of right at this moment, they are not allowing companies to take both of those.
So while we're talking about both of those and how they work together, Deb, talk to us about mixing up and taking the credits and the deferral here.
Right, because you can get both the credits and the deferral with each payroll tax deposit. So it seems to me, my interpretation of why everything is off of the payroll tax deposits and reconciled on the 941s is so it is easier to just subtract amounts and not pay in those amounts. I realize payroll tax systems have to adjust that a little bit, but hopefully they'll be able to get it doing that soon. And I think the IRS is doing everything they can by postponing all the reconciliations till the end of the quarter. Can apply the tax deferral as we did in the examples before using the credits to reduce payroll tax deposits. You do have to talk to third parties. And of course, we haven't talked at all about state taxes. State taxes is something that Ann deals with and I don't deal with at all. But each of the states have separate credits and incentives for these things. As we said, an employee retention credit can't be claimed by an entity receiving a loan. So before you receive the loan, you could perhaps claim the credit, but the minute you got the loan, I would make sure that I paid those that amount that I had claimed a credit for back in to my payroll taxes. The employment tax deferral no longer applies when the loan is forgiven. And in that case, we have specific guidance from the IRS that says the taxes that you defer between now or March 27 and when you get the loan and when the loan is forgiven will continue to be deferred. So those you don't have to pay right back in.
Okay, and so just in thinking through all of these these issues, the first thing I would consider is whether you are subject to paid leave and family medical leave and are able to take any tax credits under that provision. And then if considering again that whether you're taking any type of the loan, any loans, and whether those loans have yet been forgiven, your next step is to consider whether you can take the employment tax deferral of the employer share OASDI, and then layering in lastly the employee retention credit for those that are not taking the PPP loan. And then as you're considering all three of those, considering how you can reduce those tax deposits for the credit and requesting any refund for any excess taxes that have been paid.
Great, thank you very much. I know we covered a lot and are just hitting the end of our 45 minutes. So, and I think Deb and Ann have been answering some questions along as we've gone along, but wanted to get you up to date for as where we are right now with the guidance that's been issued with respect to these two provisions. Ann and her team have also, and Deb have also been working on some tools to help us work through some what if calculations, some analysis to help clients sort of work through these credits and the deposits and figure out in our best projected look at what a reconciliation will be at the end of a quarter. So if you'd like some help with that, you could certainly reach out to Ann and Deb to help with that analysis and conversations on those points. And if you have other questions to follow up with some specific rules and things, then Ann and Deb are great resources to check in with. Also, just if you have a Paycheck Protection Program loan, want to file one, or need some help with the forgiveness side of it, we refer you again to our website here and our team that is focused just on that program. So again, thank you very much for your attention today, and we appreciate your being here and joining with us, and look forward to talking with you on our next webinar.